Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Rausen Pereira. The Reserve Bank expects India's economic growth rate to accelerate to 7.4% in the current financial year on pickup in industrial activity and good monsoon. In its annual report released on Wednesday, the RBI also said that its monetary policy will continue to be guided by the objective of achieving the medium-term target for retail inflation of 4% within a tolerance band of plus or minus 2% while supporting growth. It cautioned that India's external sector will have to confront global headwinds, but expressed confidence that the current account deficit would largely be financed by foreign direct investment. The report notes that agricultural production is likely to remain strong, growth impulses in industry are strengthening, corporates are reporting robust sales growth and improvement in profitability, and services sector activity is also set to gather pace. The RBI also gave out demonetization figures, which we won't focus on today since it has been widely reported in the media and we would need to analyze it politically as well. Instead, on this edition of The Big Picture, we will analyze RBI's economic outlook for India. Joining me on the program today are Nitin Desai, former Chief Economic Advisor to the Government of India, A.K. Bhattacharya, Editorial Director, Business Standard, and Ajay Dua, former Secretary, Ministry of Commerce and Industry. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Desai, let me begin with you. First, of course, what are your thoughts on the RBI's outlook?
Well, I think the RBI outlook more or less is very similar to what the IMF came out with in its Article 4 consultations, which is the recovery is there. There are clear signs of recovery in terms of growth, in terms of even investment, and in terms of industry. The pressure points are known. The one is, of course, on the major one is, I believe now, is on the foreign front. And there I believe the situation is not quite as rosy as RBI would have us believe. That I think the pressures there are much greater. Basically, if our deficit is around 50-55 billion, we can afford to finance it. There are good mechanisms, but there's a chance it may go beyond that to what even some people are talking of 70-75, and in which case we will be under pressure. Second, the global headwinds because of what is happening on the trade front, the flight to safety. So I'd say that my worry is very much on the
international front.
The international front, and there I think the SBI, the IMF report is a little more. The other thing that I think the IMF report is a little more, probably a little more guarded on than RBI is on the financial sector, where they have said many things about wanting to do more need for more financial sector reforms, etc. Because I don't think we have done enough to stop the NPA problems from occurring all over again. Yes, we are sorting past NPA problems. But are we really doing enough in terms of changing the way the banks function so that future NPAs don't arise? Are we building up the capacity to finance long gestation corporate infrastructure projects? So I'd say that these are the two areas where I think we still have problems ahead of us.
Mr. Dua, what is the story that the indicators are telling us?
I would think that the Reserve Bank has been fairly realistic in its assessment of what's happened. It hasn't been defensive of the government, so to say, but at the same time it's been somewhat guarded, as was just pointed out by Mr. Desai. Things are certainly better than before, no denying that fact. However, whether those are adequate to get to a rate of growth of 7.4 requires whole lot of things to be in position, one of which, and I would say an important one constituent of which, is maintaining the investment level. All that has happened in the investment scenario is we've gone up, as per the Reserve Bank report, from 33.2 to 34.1% of the GDP, marginal take up. But at the same time, this very report says that investment and demand continue to remain tepid. That means we are not seeing much of an acceleration there. Manufacturing, slight uptake, but which are the sectors? Coal, mining, fertilizer and cements. Across the board, the kind of manufacturing upsurge which was expected. I don't think even the Reserve Bank is talking about that. So sometimes I wonder whether 7.4, it might be tallying with the IMF, but IMF has usually been fairly appreciative of what's happening in India compared to the rest of the world, I guess. So whether 7.4% rate of growth in an year, which is an election year, probably consumption only will maintain to get it, not really investment, with which we should be concerned if we are looking at the medium-term prospects.
To achieve 7.4, you're saying a lot more needs to be done, and it needs to be done soon. Mr. Bhattacharya, how are we doing on the macro front?
Well, I think I would broadly agree with my co-panelists who have touched upon the areas of concern as the external sector, which is the current account balance, and also on the question about how you make sure that the growth momentum is maintained. I would like to add to those points by highlighting two areas which the RBI annual report also points out. One is it is very clear that the current inflation trajectory is probably, it is by its own assessment, it is supposed to touch 5%, that is going by 5% in the first quarter of next year. That is his own assessment, which was made public about a month ago. Now, given what is happening on the international crude oil front, the areas that actually need to be closely watched is how the government manages this crude oil price trajectory, impacting the one, inflation, and two, the government's fiscal deficit. Let us not forget that this is an election year where the government will be hard-pressed to allow a continued, without any interruption, the transition or transmission of international crude oil price increases into the retail prices. There will be a point, if the international crude oil prices indeed go up and continue to go up, there will be a point where the government will probably either discreetly or openly say, listen, enough is enough, let's halt this process of transmitting the international crude oil price impact to the retail prices, because this is an election year. And if that is done, then in my view, it will probably have a longer term impact on the government's fisc. If you also, there's a pressure will be to reduce the excise duty on petroleum product prices. If that happens, then there will obviously be a problem of adhering to the 3.3% of GDP fiscal deficit target that will be there. That is one area of concern. The second area of concern, which is equally challenging, would be which the RBI annual report clearly points out, how the NPA resolution process is far from over. It actually tells us very clearly that the size of the NPAs in the banking sector will actually go up going forward by the end, till the end of March 2019, which means that the special mention account processes that were put in place by the RBI early this year are now actually showing how the SMA 1 and SMA 02 and SMA 03, these accounts are showing new signs of stressed loans, and they are coming out. And the February 12, 2018 circular was essentially aimed at curbing that trend, that how these things are reported to the insolvency the process, the insolvency board or the NCLT mechanism without any delaying. So my sense is that inflation and NPAs, these are the two areas of concern that need to be weighed very closely, even while we say that growth will be keeping its momentum thanks to corporate growth and other demand. So we need to be concerned about these two areas.
Concerned about NPAs and inflation is what Mr. Bhattacharya is suggesting. And all three panelists, all three of you, Mr. Desai, have spoken about how the external factor is something that we need to watch out for. How do we guard against it? What should be our strategy as far as the external sector is concerned?
One has been mentioned by AK, which is that we'll have to handle what is happening on crude oil prices carefully, because we don't know what will happen. If the Iran sanctions start biting, then we may really get some pretty nasty shocks in the course of the year. because we're only seeing the early signs of this. The real sanctions.
But there are also signs that we may possibly get a waiver as far as Iran is concerned.
well,
We've gotten that in the past.
Yes, I would not count too much on Mr. Trump's goodwill. Let us say that I would certainly not plan.
But it's
on
better
that.
to be prepared, is what you're
It's better to be
suggesting.
prepared.
Yes,
I would not count on that, on Mr. Trump's goodwill for this purpose. So, and remember that that for us, the price of violating the sanctions could be even higher. So I don't think any government would dare to do that. So let us see what happens on that front. No, I think basically I'm really concerned about why export growth is not picking up. Yes, part of the problem. And in fact, in some ways, the China tariffs, etc., should have opened up an opportunity for you in some ways. So if that happens, that will help. The point which Ajay raised, that today what we are seeing is demand growth mainly in the sectors which are heavily influenced by government spending on infrastructure. That has gone up. It has gone up in a very big way, and those sectors are showing the positive signs. What we're not seeing is that same sort of positive sign in FMCG sectors, in the machinery and equipment type sectors, and so on. For that, you need export growth and investment growth. These are the two missing bits in our scenario. And we still don't have an answer. So I would look for export growth and investment growth. Investment growth will take time. People are not going to invest till they see demand growth. So we have to, and the best way of generating demand growth is with something like, if we can just find ways of boosting. I'm not sure that the export sector has coped with the GST system well. Has it? I'm not sure. We keep hearing stories in the press about delays in this and delays in that, and so on. So if I'm advising the government, I said, handle the oil price carefully, do this and make sure that nothing happens on remittances which hurts you.
Right. Right. Mr. Dua, these are times of trade wars between the major economies in the world. Is that an opportunity for us, or is that something that we need to be wary of?
Before I answer that, could I, Frank, just highlight on the issue which you are discussing? I would be concerned about the government keeping intact the value of the rupee. That, all right, people might say that let's leave it to the market, the rupee was overvalued, etc. But the confidence of the global system in Indian economy to a large extent would depend upon how stable is our currency. We have seen spikes, and I'm talking of the current year. It may have been overvalued in the past for some time, stable, but we have seen that already 11% depreciation has occurred since the beginning of this year. And considering that the oil prices are going up, considering that foreign remittances by Indians are coming down, with things what we are seeing in the Gulf, etc., the remittances are down. And more important, I think the outflow of foreign investment, FPI, portfolio investment, institutional investment, which continues to take place now that the margins are closing between what the yields in the US were or what can be here, and with that is going to be causing concern, because the value of the rupee is going to be fast depreciation. So people have to have much higher.
I think Mr. Desai
so
wants
I
to
would remain concerned about that aspect in addition to that issue about the trade war.
Put that point more sharply. Suppose somebody came into the Indian market at the beginning of the year when the rupee was 64. Today, if he's cashing out, the rupee is at nearly 71 today.
That's right.
Now, this means that even if the Indian market has gone up, it may have gone up by 10%, 15%. But the fact is, his stake in dollar terms is down, maybe very little. Right. So this dimension must be kept in mind, that if you are depending on foreign inflows, that foreign fellow is going to look at everything in dollar terms.
Absolutely.
He's not going to look at it in rupee terms. So for him to invest at price, dollar rate X, and have to take it out at a rate which is X minus 10%, in terms of
absolutely.
dollars. It's a
You know,
big price.
I like to differ on this issue a little bit. I am all for a stable currency, but not stability achieved at the cost of an unrealistic value of the currency. Now, of course, we should avoid the kind of volatility that we saw by which the currency depreciated by around 11% from January to now. Of course, I think it should have been managed well. But the fact of the matter is this, that our reserves are not so humongous that this country can actually burn so much of dollar to keep the currency at the current level and make it stable at that. And that will be a costly price. And I don't know whether that will be a prudent move going forward. I agree that foreign investors who had locked themselves into investments here will feel that their value has depreciated. But the fact of the matter is this, that the Indian currency must be allowed to depreciate as without much disruption, without much volatility, and in a gradual way. The fact is that because it wasn't allowed to do so much, which is why the Indian currency is still very overvalued, even by taking by any yardstick. So therefore, it's important to keep the currency stable, less volatile, but at the same time let the currency reflect its true competitive worth and exchange value.
Very quickly.
Disagree with you at all on that. That's why I was using the word stability.
Yeah,
and
that's right.
Previous years,
I thought the point needs to be made.
But all that I want to say is that given our exports and the stickiness in our exports, we haven't reached the $315 billion, the highest in exports, which was reached in 2014 for 4 years, whereas our import bill continues to rise. And what we just discussed, we don't know whether we are going to be ending up at a $180 billion current account deficit or $200 billion, whether it's 2.2% of the GDP or 2.5. Those are the kind of estimates being put out. The fact of the matter is we need to, I think, be far more proactive than we are seeing currently, both the Indian traders as well as the Indian policymakers, on looking at the opportunities which the current trade war between the two trading giants of the world is throwing out.
Right.
If certain goods which the US was getting from China, and those are no longer going to be available at those rates, the question is, can we step in? Same way, the exports which were coming from the US to China, soybean was one issue which we keep talking of soya. Does it offer opportunities for India to step in and do that? I think rather than setting up committees, looking at it or so, because we don't know how long it will last. And we need the money, export, foreign exchange now.
Right.
For
so
a
there's
variety of
tremendous
reasons.
opportunity
Yes.
there is what you're suggesting,
Absolutely.
and we should fill in the void.
Absolutely.
Yes, Mr. Desai.
Well, just a little bit on the exchange rate, if you don't mind, slightly technical, if you don't mind. The fact is, yes, the Reserve Bank has been reporting the real exchange rate of the rupee has been rising, etc. But there are two problems with that. The Reserve Bank, when it says real exchange rate, it is deflating prices with the consumer price index. In our consumer price index, a big chunk of it is food and non-tradables. So if those are going up, in India, we have, as you know, we've had food price inflation in India, but the other part is not, then I will be showing that my exchange rate should have been less than what it actually is. But in fact, you really ought to be focusing only on the comparative price of tradables. Second, in many other calculations, you make an adjustment for the fact that what you have to look at is how does your rate compare with your competitors, like China, Vietnam, Bangladesh, Thailand, etc.
Your trade basket.
And but when we do a trade weight, the biggest trade weight, you know what it is? What are the biggest? United Arab Emirates. Why? Because we get oil from there. Now that does not really measure export competitiveness in a meaningful sense. If you're really talking about, so there are alternative calculations. OECD calculation of India's real exchange rate does not show a huge appreciation. It shows it more or less at the same level at about 4 or 5 years ago. So I'd say be careful. Focus more on what is it that needs to be there for export promotion.
What is relevant for us.
Which is what is relevant. And there I think basically supply side measures to boost potential in areas which are being vacated. So don't get too carried away with the notion that the RER as calculated by the RBI should change. I think there are serious problems with that calculation. Yes, you should not use up reserves unnecessarily. If there is pressure on your reserves because people are withdrawing money, ask yourself that if that is what is the reason of the problem, then you better start looking carefully because you're counting on it to meet your current account deficit over this year.
Right.
So I'd say
No,
that
Nitin, as of now, we need to be a little bit worried because with our import bill surging
yeah.
and our reserves now just about enough to finance for 8.5 months of imports. There was a time when probably we could be a little more kind of profligate about using of our foreign currency.
I just want to add a little bit to the point to what Mr. Desai and Mr. Dua have made, is that yes, we don't need to be, get carried away by this RER, but if you look at the exchange rate fluctuations between India's and China's and Vietnam's and Bangladesh, which are competing with us, the differential is not very much. They have depreciated by 7%, 8%. We have depreciated by 11%. So therefore, this 11% depreciation in the last 7-8 months is not something that I should be worried about. It probably is par for the course. What I am worried about more on the exchange rate is this: there's too much of focus on keeping the rupee at less than 70 without worrying that we should get plugged into the global value chains. And we have been dragging our feet, for example, on signing on the RCEP, on the specious ground that China will beat us hollow. But the fact of the matter is this: China is beating us hollow even without our FTAs with them. So the question is that if you sign on to the RCEP, which ASEAN is welcoming India, if you sign on to RCEP, then probably we will plug ourselves into a market which is 30 to 40% of the global export market, and get into a market with trade advantages and concessional rates. So therefore, I think we should worry about trade, rupee, but also focus on getting into the global value chains with RCEP-like
Mr.
agreements.
Bhattacharya, in course of time, probably free trade certainly will give us benefit.
Yeah.
But if it's the immediate impact of getting into RCEP, I see a bit of a downturn on our limited exports itself. Is that the right time now to move in?
I think let's move on and talk about a few more risks now.
Sure.
Talking about risks and talking about what we need to watch out for. Mr. Desai, do you believe that the shortfall in taxes is something that we need to worry about as well?
There has been growing concern on that. Yes. Over the past months, I've noticed more concern being expressed on that front. That the deficit today, I think just yesterday there was a thing from one of the rating agencies that the deficit may go beyond 3.3. So yes, there are concerns about that. Particularly, a lot depends on how the government handles the oil price issue. If they are under electoral pressures, they decide to forego some of the revenues that they today get from the excise duty on oil products, then you will start seeing a widening of the deficit. The impact of the MSP increase is also not entirely clear. So I'd say, yes, there are serious concerns about a possibility that we may not be able to hold to the 3.3% target, which is what some people have been arguing for some time. I think this is a serious short-term issue, more for perception than for anything else, because, and remember this, that now we are seeing inflationary pressures not from food, but from what is called core inflation, which is inflation minus food and energy.
Right.
Now that is very much inflation which is driven by demand-supply imbalances, more demand pressures, etc., showing up. So given that, I think a widening of the deficit could lead the Monetary Policy Committee into yet another hike.
Right. We've spoken about the external pressure, the external sector being a problem, really. So going forward, Mr. Dua, the 7.4% growth that the RBI is talking about, 7.3% that the IMF is talking about, where is it going to come from? Is it going to be due to domestic demand then? Because
I think the optimism as of now both these estimates, IMF as well as the RBI, is coming really out of the rural sector. Monsoon has been good. Everybody expects the agriculture to grow, do well, and in agriculture not only food but also the horticulture sector, which is increasing in weight. That's one. Second, the rural demand which it will generate for various segments of call it manufacturing or services, people are optimistic about that as well. Certainly not on the export front, and certainly not on the contribution of financial services, which in the past has been huge. The RBI itself has talked about asking the government to address the twin balance sheet problem. RBI is talking of saying that what the policy, that so-called circular, which it talked of the February, that to stressed assets of NBFCs also it's going to be applying. RBFC talks about or the annual report talks about tepid, demand and investment. So I think the granular work on projecting a 7.3 or a 7.4% is based on premises which are not really matching up precisely.
All right. Closing comment from you, Mr. Bhattacharya. For now, of course, the economy is showing steady expansion. I think all three of you will agree with that. What can we expect in the near future?
Well, I think we need to go beyond the current concerns. If the current concerns of fiscal deficits or growth, NPAs will have to be tackled, and I think some steps have been taken. On the revenue collection front, I agree that the tax revenue collection will be an area of concern, mainly because if the government makes a mistake of reducing excise duty. On the GST front, I think the manner in which the GST laws have been changed recently, I don't see the GST, even if there is a shortfall in the overall collection, the total collection, thanks to the compensation cess being in surplus category, and the government can now use the compensation fund through the Consolidated Fund of India. So I think the GST collection will be not an area of concern, but the real concern from the revenue point of view will come from the non-tax revenue side, and that is because of the 80,000 crore of disinvestment proceeds. Air India is not going to happen this year, and that was the big hope that some money will come in. So far, the government has collected only 5,000 crore, and no big ticket disinvestment is coming up. So there are small items, small ticket items. So my concern is on disinvestment.
ONGCs will come in handy.
Well, LIC, ONGC will not necessarily be the government, because they will be
the same government equity, say in gain.
Okay.
Yeah. So they are not.
You'll know tomorrow. You'll know tomorrow, and tomorrow's on August 31st. The first quarter's growth figures will come out. If they show growth of 7.6, 7.7%, you're okay. Yeah. If they show growth less than that, you're in trouble. If they show growth more than that, you relax.
Okay, all right. Yeah. On that note, then, I'll call it a wrap on this edition of The Big Picture. Thank you to all my guests for joining me on the program and putting things into perspective for us. That's it from me. See you again next time.